Few phenomena in the business world are more divisive than private equity. But what is it? Private equity is a form of investment where investor funds are used to acquire ownership in private companies with the goal of improving their value and eventually selling them on for a profit. Before launching into the criticisms, of which there are many, let's look at an archetypal private equity success story. In 2007, market giant Blackstone bought Hilton Hotels for $26 billion. Hilton had remained profitable throughout the early 2000s, but it had been suggested that the company was falling behind competitors like Marriott in terms of profitability, brand strength and strategy. Blackstone set about restructuring its massive debt load, investing in technology and branding, and expanding internationally. The company was able to weather the financial crisis of 2008 and improve its profit margins at the same time. By 2013, Hilton went public again in what was then the biggest hotel chain IPO in history. Blackstone made around $14 billion on the deal. Advocates argue that private equity at its best can be transformational. It can inject capital into struggling businesses, overhauling broken systems and shedding dead wood. But let's not get carried away. Critics argue that private equity often prioritises short-term gains over long-term health. Private equity firms often purchase companies via leveraged buyouts. A leveraged buyout is when a firm or fund buys a company with mostly borrowed money, then saddles the company itself with the debt. The private equity firm profits if the company survives, or even if it doesn't. In 2019, British high street chain Debenhams collapsed, following several years of ownership under private equity in the early 2000s. Debenhams was acquired by a private equity consortium in 2003, with the buyers providing £600 million in equity and adding £1.2 billion in debt as part of the purchase. The company was subsequently further weakened by the sale of its assets, when in 2005 23 of its shop freeholds were sold to property investment firm British Land, before being leased back with an average annual rent increase of 2.5%. Prior to the private equity takeover, Debenhams had had debts of approximately £100 million, which had ballooned to more than £1 billion by the time it was relisted on the London Stock Exchange in 2006. Weighed down by debt and management missteps, the 200-year-old retailer couldn't compete, and thousands of people lost their jobs when it finally collapsed. Whilst other factors like changing consumer habits and the impact of COVID undoubtedly played a part in Debenhams' demise, retail experts have since argued that the firm was so weakened by its time in private equity ownership that it had been stripped of the means to save itself from these challenges. Similar stories unfolded with Toys R Us in the US and Australia's Dick Smith Electronics. Critics say these weren't just retail failures in the wake of a changing world, they were crushed under the weight of financial engineering. Advocates of private equity would argue that when run properly, managers can return ailing companies to fiscal health by streamlining processes and cutting costs. While improved efficiency is no bad thing, slashing jobs or services can erode the very value that made a company worth buying in the first place. In the US, studies have shown that private equity takeovers of nursing homes were linked to lower quality care and even higher mortality rates. Private equity operates largely behind closed doors. Whilst it is possible for private equity to own large stakes in publicly listed organisations, this is not the norm. Many a publicly listed company has been removed from a stock exchange by private equity, in a transaction type known as public to private. There are many healthy businesses around the world that are held in private ownership, so this isn't inherently a problem. But in large multinational operations, the public shareholder model disperses power among a wider group of people and offers a more democratic access to capital. Furthermore, privately owned companies are subject to less oversight and are obligated to provide fewer public disclosures. Often, this goes hand in hand with very complex structures that make accountability difficult. This isn't just an issue for the companies targeted. Individuals who invest in private equity funds have increasingly called for greater transparency and more rights where the holding and spending of their money is concerned. So is private equity bad? It depends. At its best, private equity is a catalyst for rejuvenation. At worst, it's a wrecking ball,